Hello everyone and welcome to Financial Accounting. In this video, we will look at more business transactions using the Integrated Financial Statement Framework. Today, we will look at recording expenses. An integrated financial statement framework is very helpful for non-accounting majors and those who are new to accounting and have problems understanding debits and credits. It demonstrates the impact of transactions on the balance sheet, income statement, and the statement of cash flows, and the corresponding relationship among these financial statements. I have a video discussing the basics of the financial statement framework. If you would like to watch it, I'm posting the link here and in the description below. The accounting equation is the basis for the framework. It is expressed as follows: assets equal liabilities plus stockholders' equity. Now let's look at expenses. An expense is the cost incurred by a company in its operations in order to generate revenue. In other words, an expense is the use of assets to create sales. Common expenses are the cost of goods sold, rent expense, wages expense, fixed assets depreciation, and utility expense. Under cash basis accounting, an expense is recorded only when a cash payment has been made. Under the accrual basis of accounting, an expense is recorded when there is a reduction in the value of an asset, irrespective of any related cash outflow. Emily paid the monthly rent for the office and equipment of $5,000. This transaction increases expenses, which decreases cash flows from operating activities by $5,000 under the statement of cash flow column. Note that cash flows from operating activities refer to cash inflows and outflows related directly to the revenues and expenses reported on the income statement. Under the balance sheet column, cash will decrease by $5,000, and the increase in expenses will also decrease retained earnings by $5,000. Remember that both revenues and expenses are a part of retained earnings, which is a part of stockholders' equity. Revenues increase retained earnings and stockholders' equity. Expenses decrease retained earnings and stockholders' equity. After this transaction, the balance in cash is $187,000, and the retained earnings balance is $47,000. The balances of notes payable and capital stock remain the same. Note that we already have 3 transactions on the slide. I have a video for each transaction. I'm posting the link to the playlist here and in the description below. Under the income statement column, rent expense will appear as a decrease of $5,000. Let's look at another expense transaction. In this transaction, the company paid automobile expenses of $2,500 and miscellaneous expenses of $1,500. This transaction decreases cash from operating activities by a net amount of $4,000, calculated by adding $2,500 and $1,500. Under the balance sheet column, both cash and retained earnings are decreased by $4,000. This reduces the balance in cash to $183,000 and retained earnings to $43,000. The balances of notes payable and capital stock remain the same. Under the income statement column, auto expense is reported as a decrease of $2,500, and miscellaneous expenses reported as a decrease of $1,500, since expenses decrease net income. In the next transaction, the company paid office salaries of $5,600. Similar to the previous transactions, expenses incurred decreased cash flows from operating activities. Under the balance sheet column, cash and retained earnings will decrease by $5,600. This reduces the balance in cash to $177,400 and in retained earnings to $37,400. The balances of notes payable and capital stock remain the same. Under the income statement column, the salaries expense transaction is reported as a decrease of $5,600. In the next transaction, the company paid an interest expense of $400 on the note payable. Since this is an operating activity, cash flows from operating activities will decrease by $400 under the statement of cash flows column. Under the balance sheet column, cash and retained earnings are decreased by $400. This reduces the balance in cash to $177,000 and in retained earnings to $37,000. The balances of notes payable and capital stock remain the same. Under the income statement column, interest expense transaction is reported as a decrease of $400. The balance in the stockholders' equity is $137,000, which is $100,000 in capital stock plus $37,000 in retained earnings. Note the accounting equation for each transaction and the totals balances. Also note that the ending cash balance on the balance sheet and on the statement of cash flows is the same. At this point, the ending balance in the retained earnings and the net income on the income statement are also the same. In the next video, we will analyze a land purchase transaction. I hope you found this video helpful. If you did, please subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.